We're doing record business. We're doing business, and you have to look at the fundamentals. Companies are pouring back into this country. They're pouring back.
Donald Trump says the U.S. economy is thriving under his leadership. We'll discuss the impact of his administration's policies on Wall Street, employment, and international trade. Hello, I'm Nathan King, filling in for Anna Naidu, and this is The Heat. Hello again. US President Donald Trump has long touted his ability as a deal maker. And under his America First campaign, Trump and his economic team have made big promises about US economic growth. One of his biggest accomplishments, the tax reform bill, is significantly lowering taxes for corporations from 35% down to 21%. President Trump also loosened environmental regulations and supported controversial projects such as the Keystone XL pipeline line across the Dakota Access Pipeline too. In his speech to the Conservative Political Action Conference, Trump said deregulation has made a big difference for the American worker.
I signed certain bills, and I'd have farmers behind me, and I'd have house builders, home builders behind me. And these are tough people, strong people. They've fought hard. They've worked all their lives hard. And there'd be half of them would be crying because we gave them their property back. We gave them the right to earn a living. They couldn't do it. They couldn't do what they had to do. We gave them their property back. We gave them their dignity back.
And joining us here in the studio to discuss all this is Elizabeth Larus. She is a professor of political science and international affairs at the University of Mary, Washington. From Leesburg, Virginia, we are joined by Chris Versace. He's Chief Investment Officer with Tematica Research. Also here with us in the studio is Joe Minarik. He is a Senior Vice President and Director of Research with the Committee for Economic Development, a non-profit, non-partisan organization. And Brian Bosche is the Chief Executive Officer at the Millennial Solution, a millennial strategy firm. He joins us from Sacramento. Thanks all for joining us. Joe, let's start with you. A very confident US president there about the economy. Is it the economy stupid? Because it seems that the US economy, it seems to be firing on all cylinders at the moment.
Well, we've been expanding from the bottom of the financial crisis, which went on from 2007 through 2010. Since that time, the economy has been growing quite consistently. We've gotten to the point now where I think most economists would say that this is pretty much a mature expansion. Questions are being raised about how much longer this can go on. The Federal Reserve is now talking about raising interest rates possibly 4 times this year rather than the 3 that were anticipated. So it's going to be a very interesting change of trajectory on this economy to try to keep going in a stable fashion now that we've gotten pretty close to full employment.
Chris Versace, is the glass half full or empty? Because Joe was pointing out there that this could be some sort of tipping point. We're seeing interest rates go up, bit of inflation, even though we've got full employment, a roaring stock market. Is this the tip of is this the tip before we see the fall?
You know, it's a great call, great question, excuse me. And, you know, from our perspective at Tematica, we don't necessarily see a recession or any hard fall off coming. We do have concerns about the ability of the economy to hit 3%, 4% growth. We've got some demographic headwinds that are going our way. We've got rising interest rates. We've got consumers that have borrowed, you know, more debt than they probably should have in a rising rate interest rate environment. So those are some of the headwinds. But we are seeing the positive impact of deregulation. We will see companies investing in property, plant, and equipment. We will see wages move higher, and that bodes well for some incremental spending, we think. So we would say that we're probably going to be somewhere, continue to be in that 2.5%, you know, GDP range over the next year or two. But again, remember, we are long in the tooth in this current expansion, and at some point, we will see a recession. Do we see it near term? We do not.
Brian, the Trump administration has got a lot going for it. Some would say that the Obama administration's policies have spilled over. But, you know, he's been over a year in the job. He takes credit for when it's good, and he'll be hit when it's bad. But there are some really interesting things. Deregulation was mentioned, but also of energy. I mean, oil is an increasingly booming industry here. I think the U.S. is going to be becoming the biggest oil supplier in the world, natural gas. We have deregulation. And because Trump is a businessman, some of his supporters have said, look, that's just good for the animal spirits of the economy, that it's not Obama, that he somehow understands the free market a little bit more. Is that what we're seeing going on, the animal spirits picking up?
Yeah, I think what's going on here is not as much about the numbers and the metrics, but I think very much this is about a president who knows how to speak confidence into the American economy, a president who knows how to speak confidence into the American people, that their future is bright, that there's more money in their pockets, that they have a growing business. And I think he has the ability to speak confidence into American companies, those that are here and those that are coming back. I think we have to remember that the economy is run by people, and people are emotional. And they make emotional decisions. So what's interesting about this president is that he's giving a real sense of confidence to those that are the movers and shakers in the U.S. economy. Not just Wall Street, not just the big banks, but also that those of us who are on Main Street building businesses from the ground up.
Elizabeth, also Trump is being helped a little bit by global demand, isn't he? I mean, it's the first time we've seen in some time where all the regions of the world are actually growing. Europe's positive, Asia's going like gangbusters, Africa's doing well, and here as well. Is that helping?
It absolutely is. There's some real tailwinds that are giving some momentum, to this economy. In the globalized economy, one economy does well, it tends to bring others along. And so, as you just said, Europe is doing well. China, when it looked like the economy was, the economic growth was slowing down a little bit, it accelerated again. The United States has picked up steam. So this is good all around.
Joe, let's hear from the new Fed chair. He was giving testimony today on Capitol Hill. They've got a lot of interest rate hikes already baked into the cake. Let's just have a listen. I'll get your reaction off the back.
Lower corporate taxes should lead to higher investment, and the effect is not easy to estimate, but you would think, and the studies find that it should lead to higher investment. Higher investment should lead to higher productivity over time, and higher productivity should lead to higher wages over time. It's very hard to put your hands on exactly how much that would be, but higher productivity, of course, is very, very welcome and will be driven by higher investment.
The word should there stood out because that doesn't necessarily mean it's a given. And even though the U.S. economy is humming along, there has been some real questions about sort of long-term demand, productivity growth, structural weaknesses, and that potentially lower corporate taxes and lower tax rates don't necessarily solve that. So what are the big questions going forward?
Well, Jay's making a point that you're looking at the cost of capital for businesses,
which is going up.
Interest rates rise, taxes go down. Generally, interest rates win in that contest. Economists who do the math and grind the numbers will tell you that interest rates are actually more powerful than our tax rates. And in particular, we're looking at expensing of more physical investment. When we get there, tax rates become much less important, and interest rates become a much bigger driver of those decisions. So the chairman is being careful, and he should.
Yeah, Chris, what about investment decisions going forward? Are companies who, let's face it, are flush with cash, especially off this corporate tax rate deduction, and also being able to repatriate all those billions and trillions of dollars overseas, is it time for this big investment, or are we going to see interest rates sort of hampering that?
Well, it's an interesting question because whenever we talk about building new property, plant, and equipment, at some point we have to have the people conversation. People will either build the facilities, build the equipment, or perhaps work inside these facilities and factories. And one of the biggest concerns that we have seen in the monthly JOLTS report here in the U.S., or even for the small business reports that come out every month, is the lack of skilled workers. So, we're a little concerned that we understand that companies want to spend. In some cases, property, plant, and equipment is, 40, 50 years old, antiquated, needs to be updated, no question. But where are the people who are going to be there? It's hard to see companies say, yes, we're going to invest and build a facility, but we won't have anybody to work here. We think that might temper some of the expectations that are being put out in the marketplace, earlier in the year and currently. Could be a headwind in the short term, but from our perspective, that's going to call for a lot of training, a lot of, as we call it, our tooling and retooling investment theme.
Some people might be scratching their heads over this. Joe makes a good point, Brian, but we've never seen unemployment lower. I think I was looking at the weekly jobless claims at a 45-year low. The 17-year low in terms of the number. But is it the quality of jobs in the U.S. economy that is still a problem?
I look at it from a millennial perspective. I spend most of my time with Fortune 500 executives, working on their strategy to attract the next generation of talent. And when you look at the next generation of talent, think about when they came out of school, sometime between 2007, 2010, right around there, when the economy took a dive. This is the first time in the millennial generation's adult life that they've had jobs in their skill sets and that they've seen what an up economy looks like and what that means to their paycheck. But when it comes to that skills gap that Chris was referring to, it is an actual problem. Now we have a lot of opportunity here, a lot of investment, and companies, in addition to the buildings, in addition to the technology, because the entire world, contrary to what Silicon Valley thinks, is not going to be run by AI, we're going to have to actually train these employees, these new employees, how to do the jobs of the next, this next move in our American economy.
Joe, you want to say something?
Just wanted to add, Chris mentioned earlier the demographic headwinds. We are seeing a much slower rate of growth of our potential labor force. So one issue is training. I think Brian is right about that. Chris is right about that. But we have to have people to train. And as the baby boomers exit the workforce and these smaller, younger generations are coming online, we've got a rate of growth of our potential labor force which is getting very close to zero. And that's going to be a problem.
I look at China all the time, and they do have this graying workforce as well. Do you see similarities in the structural problems the United States is facing along with China?
Well, China has is facing some real problems, with its demographics. I think the United States perhaps maybe is in a better situation because of immigration.
Well, that's been curtailed.
Not legal immigration.
Right.
Right. And let's talk about illegal versus legal immigration. But the United States, much of Europe, Russia, would be literally dying because they are not replacing their populations, but for immigration. And so, yeah, for the United States, if you have an aging population, you do need to get, labor from somewhere. China's population is aging, very rapidly, and then what you're seeing is, rising labor costs and some real, problems there that I think the United States is in a bit of a better shape there.
Chris, do you see, in terms of workers' wages as a problem? Because, immigration has actually arguably, including illegal immigration, but also legal, at the low end of the wage spectrum, kept wages down, especially in agriculture and the like. But you're seeing wage increases, although there's headlines of $11 an hour, but it's not happening that rapidly. What would be the sort of sweet spot for Trumponomics here? Because he has touted the bonuses that are being paid and the like.
Yeah, let me just say one thing. You remember the stock market kind of got in a tizzy when we got the January employment report. Yeah. It showed, headline wages of growing 2.9%. When you dig into the real earnings report that came later, we saw that is mainly for managerial positions. They were up about 5% year over year. The vast majority of workers, some 82%, actually saw no wage gains year over year. And that's the regular, non-supervisory, non-management job. So I think we need to be careful with that, make sure we understand exactly what's going on. I think some of that, to your question, Nathan, is dealing with the kind of jobs that we're seeing. If we look throughout, the monthly job reports, we've seen some construction jobs created, other good-paying jobs. But over the last, several years, we've seen a lot of lower wage jobs being created from hospitality, restaurants, that sort of thing, retail, for example. You know, so to me, the opportunity for the Trump economy, to answer your question directly, is let's get construction going as part of rebuilding U.S. infrastructure. Let's get companies back in the U.S. and back manufacturing and putting people to work in good quality jobs. That needs to be a priority ahead.
Joe, what about this wage pressure? Because obviously middle class incomes have been stagnating for quite a while, not at the top end, as eloquently pointed out there by Chris. But $11 an hour doesn't cut it if you want to create demand in an economy, right?
Well, that's true. We have been asking a question now for more than the Trump administration, going back into the Obama years. The drop in labor force participation at the tail of the financial crisis is beginning to unwind itself. And the question then becomes, when do we get to the point where those wages are going to begin to see pressure from the shortage of labor overall, the slow growth of the labor force? The reason why people were looking at that wage report very critically was because they were concerned that at some point we're going to hit the wall in terms of labor supply. And at that point, we expect wages will begin to rise.